Welcome back to this week's market update. Today is Monday, June 24th, 2024. This will be our last update of the month of June and the first half of 2024. So time has just flown by, but with that, we'll jump right in. Economic data continued to show some softness over the past week with the release of retail sales, existing home sales, leading indicators, and the Philadelphia Fed's Manufacturing Business Outlook Survey. As of Friday, June 21st, we saw the Dow take the lead, up 1.45% for last week, making progress towards closing the gap between the rally that we've seen in the S&P 500 and the Nasdaq. And then we saw the S&P up about 0.6% on the week, Nasdaq completely flat, and the Barclays Aggregate Bond Index down about 0.16 on the week. Perhaps one of the larger data points of last week, we had May retail sales, where the retail sales numbers came in much lower than expected. So here you can see it was up 0.1% month over month, so still positive, but this was much lower than the 0.4% gain that was expected. On a year-over-year basis, this was only up 2.3%, so that's quite weak, especially considering inflation is still above 3%. So on a real basis, retail sales were actually down slightly from a year ago. And then by category, we saw retail sales, excluding the impact of a strong month of auto sales. You can see that was up nearly a whole percent in the month of May. Excluding that, it was actually down 0.1% month over month in May here. Then breaking it down a little bit more detailed, we saw furniture down quite a bit month over month, food services down also, and grocery as well. So some interesting categories here, seeing a drop in the total amount of sales in the month of May. And then on the positive side, we did see online shopping. That continues to be a very strong category for total retail sales. And clothing was also up quite a bit in the month of May. So some really interesting dynamics here, but overall a softer than expected month of retail sales data, showing that the consumer might be pulling back going into the summer. Also last week, we got existing home sales data for the month of May, showing 4.1 million homes sold in the month, but this was down 0.7% from April and down 2.8% from a year ago. However, when you look at the median sales price, this was up to an all-time record of $419,300, which was up 5.8% from a year ago. This was also the highest annual median price increase since October of 2022. So, although we are seeing volume slip down quite a bit off of a very hot market, the prices are stable in most markets or rising. You can see the median here is rising 5.8% from a year ago to an all-time high. So no serious cracks in the residential real estate market yet. However, we are seeing inventory increase slightly from a year ago. So about 3.1 months a year ago to 3.7 now. We are seeing some slowness, but the median sales price has been steadily increasing, and we are not seeing serious cracks in this data yet. Another economic data point we always love to look out for is the leading economic index from the Conference Board, and that was showing a 0.5% decrease in the month of May and a 2% decrease in the 6-month period ending in May. So that is a slower pace of decline than we've seen in previous months, although the LEI does still look quite bearish. And then when we break down the LEI, which is really just a composite of some really important leading economic indicators, you can see things like the S&P 500 drove it up in the month. However, the interest rate spread or the inverted yield curve that drove the index down. We also saw consumer expectations drive the index down. New orders also drive it down here. Building permits drive it down. And then we saw average manufacturing weekly hours up slightly in May. But overall, the LEI continues to show some warning signs of a possible slowdown ahead. However, the pace at which the LEI has been declining has slowed down quite a bit. So it's not quite as bearish as it was maybe 6 months ago, but it does still look bearish. The Federal Reserve Bank of Philadelphia also posted their Business Outlook survey last week for the month of June, which is the survey of regional manufacturers on various aspects of business activity, which then produces a current activity index and a future activity index. In the month of June, we saw both indexes decline here, but they are both above zero. So think of this like a regional ISM manufacturing index, but in the third Federal Reserve District, which is the surrounding area of Philadelphia. Anything above zero is considered positive, anything below zero is considered negative, and then anything around zero is quite neutral. So we were in quite positive territory even just a few months ago, but in recent months we have been trending down towards this more neutral territory, but it is still above zero. So overall, that is a positive trend. You can see on the longer term there. But within the index, we can see 32% of firms expected growth in the next 6 months, which is quite neutral. 47% expect no change. So that's quite interesting there that firms are generally expecting little to no change in growth over the coming 6 months. And then on the front of prices, 26% of firms reported higher input costs, but only 14% reported raising their own prices. So this could put a bit of a squeeze on manufacturers' bottom lines. But again, this is really only in the third Federal Reserve District out of 12. So it does not fully encompass the entire US manufacturing landscape. So overall here, very interesting, but a kind of a neutral to slightly bearish indicator. And then one final thing, we like to take a look at a variety of economic indicators on a frequent basis. So just looking at a list of a select few of the indicators that we like to see every single month, every single week, or quarterly, however much they come out. You can see the LEI that we just took a look at. That we do rank as a bearish factor, and then the Philly manufacturing Business Outlook survey that is still looking neutral, although it is on a downtrend in recent months. Other things like the Employment Trends Index, that's been bullish still for the last few months. The Anxious Index, which is an indicator of forecasters' probabilities of real GDP declining or just the chance of a recession in plain language. That looks bullish as well. We see the ISM Services Index continue to look bullish and the Philadelphia ADX Index as well. We see the ISM Manufacturing Index continue to be bearish and the Chicago Fed National Activity Index that continues to look neutral. So overall, we view the US economy as stable, but there are some significant risks ahead. So think of the Fed's rate cutting cycle, seeing how fast they do and for what reasons they cut in the coming months and years, as well as things like geopolitical risk, the elections, and a variety of other factors we think will impact these economic indicators. So really interesting stuff here, but overall we do see the US economy as still stable for the time being. So thank you so much for tuning in to our market update this week, and we look forward to providing another update to you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.